Welcome back to Investing Talk Podcast.
Today we're looking at Kratos Defense and Security Solutions.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. Kratos is a really fascinating case because they sit right at this intersection of, high-tech defense and these really disruptive cost models.
And they've been building up some serious momentum. You just have to look at their recent performance.
Oh, absolutely. The Q3 numbers, for example, really turned heads.
They really did. That revenue number, $347.6 million, that's a 26% jump year over year.
Which is huge.
Mm-hmm.
And more importantly, it just blew past the consensus estimate.
Mm-hmm.
I think analysts were looking for something around $323 million.
Right. So they didn't just meet expectations, they smashed them.
Exactly. And that strength, it carried right down to the bottom line. Their earnings per share came in at 14 cents.
Beating the 12 cents everyone was expecting.
Right. And when you see that kind of consistent beat on both the top and bottom line, it tells you there's some really strong execution happening internally. They're not just riding a wave, they're navigating it well.
Okay, so that's the recent past, but here's where it gets really interesting, especially if you're looking at the future.
This is the key part of the story.
Yeah, the current year EPS is, it's fine, about 31 cents. But the projection for 2025, it's just staggering.
It is. The average forecast is calling for growth of nearly 400%.
397.4% to be exact. I mean, where does that even come from? You just don't see those kinds of numbers in this sector.
Well, it's not just wishful thinking. It's rooted in very specific, high-value programs that are hitting their stride. The growth engines are pretty clearly their unmanned systems and the Kratos Government Solutions divisions.
So we're talking about things like the MACHTB contract, right?
Yeah.
The $1.45 billion one.
Exactly. That's a massive deal. It's basically a national test bed for hypersonics and, advanced drones.
Which are arguably the two highest priority areas for military spending, not just in the U.S., but globally right now.
And Kratos has carved out a huge piece of that pie. That contract backlog gives them the visibility they need to make those, almost unbelievable growth projections actually seem feasible.
So the income statement looks explosive, but is it built on a solid foundation? I mean, what does the balance sheet look like? Is this growth on quicksand?
That's the right question to ask, and this is where the picture gets even stronger, I think. Their financial health is exceptionally robust.
Okay, so what are we seeing there?
Well, just look at their liquidity. The quick ratio is at 3.68.
Meaning they can cover their short-term bills almost 4 times over with assets they can sell quickly.
Exactly. But the real standout number for me is the debt-to-equity ratio. It's almost zero, just 0.04.
Wow. Okay, so in simple terms, they're funding all this incredible growth without taking on any meaningful debt.
That's it. It's all coming from equity and their own earnings. This makes them incredibly agile. They can jump on new opportunities without having to go cap in hand for financing. It's a huge structural advantage.
It has to be, especially when they're up against some of the older, larger prime contractors who might be carrying a lot more debt on their books.
Right.
But financial strength is one thing. How do they protect themselves? What's the competitive moat here that stops a giant from just coming in and copying what they do?
If we connect this to the bigger picture, their whole moat is built on this really radical and proprietary strategy. It's all about affordable, attritable, unmanned systems.
Okay, let's break that down. Attritable. That's the key word in this whole story, isn't it?
It is. It's a complete paradigm shift.
Yeah.
Attritable basically means it's designed to be high-performing, but cheap enough to be expendable.
So designed to be lost.
In a way, yes. Think about traditional military jets. They cost hundreds of millions of dollars. The mission can sometimes become more about protecting the plane than achieving the objective. Kratos comes in with something like their Valkyrie drone. It delivers incredible capability, but for just a few $1 million. Suddenly, it makes tactical sense to send it on a high-risk mission where you might actually lose it.
It's such a wild concept. Build something brilliant with the expectation that it might not come home.
But that philosophy is what creates those high switching costs for the Department of Defense. Once you start planning your strategy around this new capability, it's very hard to go back.
And what's the specific tech that underpins this? What do they own?
It's their IP portfolio. You have the Valkyrie, of course, but also things like their EPOC-8C2 software, the Ragnarok missile, and the Zeus motors, which are absolutely critical for hypersonics.
So this collection of proprietary tech gives them a cost advantage that lets them punch way above their weight.
Precisely. And we're seeing it pay off. They just landed $42 million in recent Navy and air defense contracts. Plus, their integration with Airbus OneSat was a huge success. The strategy is working.
And all of this whole fundamental story, has just lit a fire under the stock price recently.
Momentum is, putting it lightly.
I'd say so. The stock surged, 13.4% on January 5th alone?
Yeah, and it hit an intraday high around $90 on volume that was 34% above average. That's not retail chatter. That's serious capital moving in with conviction.
And it's not just a one-day thing. Over the last year, the stock is up almost 190%. A massive, massive long-term rally.
It really is.
But that's the big question then. After a run like that, isn't all the easy money already made? Where's the upside from here?
Well, that's where you have to look at what the analysts are saying. And despite that huge run-up, the sentiment is still overwhelmingly bullish.
You've got firms like BTI with price targets around $95, JMP's even higher at $105.
Exactly. And that optimism isn't just based on the past. It's anchored in that future contract visibility we were just talking about.
I saw some analysis suggesting that even at today's prices, the stock might still be, 21% undervalued? With a fair value of around $100.
And that view seems to be backed up by what the big institutions are doing. They're accumulating shares.
Right. Pacer Advisors bought over $2 million worth. Calamos started a big new position.
When you see institutional ownership sitting at nearly 76%, it's a pretty strong signal that the smart money believes in this long-term story.
So we have explosive growth, rock-solid financials, and powerful market conviction. It all sounds great, but we have to talk about the risks. Okay, let's unpack this. What's the bear case here? What could go wrong?
The main risk, and honestly it's a giant red flag, is all about that valuation.
The price you're paying for all that future growth.
Exactly. When you're forecasting nearly 400% earnings growth, the market prices that in. And it prices in perfection.
And the metrics show that, don't they? The
Right.
price-earnings ratio is, what is it?
Yeah, it's extremely high, 233.21. The price to sales is also pretty stretched compared to its peers.
Wow, a PE of 233. There is just no margin for error built into that price.
None. This raises an important question. Can they really sustain this? The market is trading on pure faith that they will execute perfectly. Any contract delay, any slip in margins, it could be catastrophic for the stock price.
Are there any internal signs? Is management showing any caution?
Well, this is where you get some mixed signals. We're seeing insiders, including the CEO, have actually been net sellers of the stock recently.
Which can sometimes mean that they think the stock is, fully valued at these levels.
It can. And you also saw at least one big fund, Allspring, trim its position pretty significantly.
By almost 30%, I think.
Right, so that's a sophisticated player who's clearly looking at that high valuation and deciding to take some risk off the table.
So how do you square that? You have the high PE and some insider selling on one side, but then you have these $100 price targets and incredible fundamentals on the other.
I think the prevailing view is that those risks, while real, are somewhat mitigated by the sheer visibility of their contract backlog. The market is willing to pay that premium because the growth is so visible in a high-priority sector. You're buying tomorrow's defense architecture, and it's priced that way.
Which brings us to what to watch for. What are the key catalysts, the milestones we should be tracking over the next few months to see if that bullish thesis is staying on track?
The first big one is the next earnings report. That's expected around April of 2026. The market will need to see that revenue growth stays strong, hopefully at that 26% pace or even better.
And beyond the numbers, we need to see actual physical progress on these big contracts, right?
Absolutely. We need to see updates on the MACHTB contract ramp-up and confirmation of deliveries. We're also looking for news on those 60 Zeus hypersonic motor units. Those are the tangible proof points that they're executing.
And we're hearing whispers of growth projections stretching out even further.
Yes. Some estimates suggest organic growth could hit 15 to 20% in 2026, and then maybe accelerate towards 23% in 2027. A lot of that is tied to the Valkyrie program really hitting full production.
And I'd imagine international expansion is a possibility too.
A big one. Keep an eye on Europe. That could unlock a whole new market for them.
And finally, when you just zoom out, The macro environment, I mean, the tailwinds just seem to be getting stronger.
They're significant. Geopolitical tensions are pushing defense budgets up everywhere, but the critical thing is how that money is being spent. It's shifting away from old, expensive platforms and directly into affordable next-gen systems. Kratos is just perfectly positioned for that shift.
So you combine the analyst targets up to $105 with this multi-year growth runway. The potential upside is still pretty compelling, assuming, of course, they can deliver on the perfection that's baked into that PE of 233.
So the core thesis is really this. Kratos seems uniquely positioned for several years of outperformance. Their niche in hypersonics and these affordable, attritable drones gives them a real competitive advantage. And that should fuel some significant margin expansion as they scale up.
You know, the really fascinating thought for me is how their whole approach making high-tech military gear expendable doesn't just help their bottom line. It fundamentally challenges the entire global model for how militaries buy equipment. They're not just selling a drone, they're selling a whole new way of thinking.
And to stay informed on this story and many other critical market analyses, make sure you subscribe to the show.